Welcome back to the channel, guys. Today we're going to talk about a fixed rate versus variable rate mortgage and why you should pick one over the other. Alright guys, before we can talk about the types of loans, we need to make sure everybody understands how a loan works and what it entails. So to do that, we're going to use a generic home purchase situation. So let's say you purchase a house for $200,000 and the bank gives you a 5% interest rate. Now, you're going to pay 5% of interest on the loan every year. So the way this math would work out is you take $200,000 times 0.05 being 5%, and it's going to give you $10,000 a year. Now, you're going to pay $10,000 broken up across 12 months. So in your first month, you would pay $833.33 in interest. Now, you're also going to have a principal payment built into that. So you may have about $1,000 a month mortgage payment, and only $200 or so of that will go to your principal or paying off that $200,000. Now, what you need to understand here is when you calculate your second month's payment, you will reduce the total cost of the loan from $200,000 by how much you paid in principal, not by interest, because the interest is what you're paying the bank for the loan. So you would reduce your $200,000 by $200, and then you would do the same calculation again at the beginning of each month or end of each month, depending on when your payment is. Because your payment recalculates or amortizes at the end of every month, you can actually save money by making payments at the 15th day to help reduce the total principal before your interest payment comes due. But now that you understand how your loan works, let's discuss the different types of interest rates. So, what is a fixed rate loan? A fixed rate loan means when you sign the paperwork for that loan at whatever interest rate was provided with the loan, that is the interest rate you will have for the life of that loan. So your example, back to the $200,000 house, you signed a 30-year, 5% interest loan, and what's going to happen is that loan is going to be established so that in the 30th year, you will make your final payment to pay off that $200,000. However, that doesn't necessarily mean you paid $200,000. Because you paid 5% every year of interest, you really are going to pay approximately $380,000 to $400,000 in total. $200,000 of that is going to be the house you purchased, and the other $180,000 to $200,000 will be the interest you paid. Now, because you had a fixed interest rate, that rate never changed from the time you closed on that loan to the time you paid it off, unless you've done a refinance or some kind of loan forgiveness program. However, in a standard situation, you're going to have the same rate for the entirety of that loan, and it makes it easier to track what your payments will be and how much you can reduce your interest by making extra payments. Now, in my opinion, this is the safer of the two loans, but you're going to pay a little bit more because the bank has less opportunity to make more money if rates go back up. So you're going to pay a little bit more over time because you have a higher interest rate. However, you know that rate won't change and you won't be in for any surprises if interest rates were to spike, which is something we're dealing with currently in 2022. We're expecting between 4 to 8 interest rate rises in the next year to 2 years. All right, guys, so now we're going to discuss the variable rate loan. Now, in my opinion, this is a much riskier loan and has been shown to cause problems within the economy when they're overused. So a big thing that occurred was in 2008, everybody got these large loans with really low variable rate interest rates. But what ended up happening is after a few years, when the variable rates kicked in and interest rates spiked up really fast, everybody's payments increased by several percentages. So you went from a 2.5% to 3% interest rate to all of a sudden a 5 to 8% interest rate on $400,000. You're looking at $12,000 every year additional 2-year payment on top of what you are already paying. So to break this out, how the loan is usually structured. Traditionally is going to be a 5-to-1 rule. What this means is, let's say you purchase that same $200,000 house, instead of a 5% interest rate, let's say they give you a 3.5% interest rate, meaning on $200,000 you're going to pay $7,000 a year, but that is for a limited amount of time that it's locked. So a 5-to-1 rate means for the first 5 years, you will be locked in at that 3.5%. However, when that time expires, every 1 year, your rate will be adjusted to reflect the current market rates. So if you were originally locked in at 3.5%, but interest rates spiked up, you could easily be at the end of your 5th year at a 5 to 6% interest rate. And that doesn't seem like a big jump, except for when you actually do the math and you realize that a 3% increase on a $300,000 house is $9,000 a year. And that is where the risk actually comes in, is you're getting a better deal up front. However, in the long term, this can flip you upside down from a finance standpoint, because if you were to come onto hardships and not have extra cash, and then your interest rate were to spike or double after 5 years, your monthly payments could take a huge increase that you can no longer financially support. And it's a risk that you have to be ready for, and if you don't remember it, it could bite you. However, with the fixed rate loan, you know what your rate is from the time you bought that loan to the time that the loan is paid off. Now, we purchased a house 3-4 years ago, and we had almost a 5.5% interest rate on that house. Now, when we moved out and bought this house, we had rented that property, and interest rates began driving down very fast. So what we realized was we could actually pull a big portion of our initial investment into that house out and then still drop our payment by almost $100. So this put money back into our pocket, as well as reduced a payment that was already relatively low. But the real benefit to this was, even though we pulled out, let's say $25,000, and our payment stayed roughly the same, because the interest rate was so much lower, nearly half, we will still save approximately $30,000 in interest over the life of that loan. So there's a lot of things to look at outside of just what your monthly payment is and the cost to get that loan or refinance that loan. Now, with variable rate mortgages, many of these things apply, but you want to ensure that in any loan, there are no fees for refinancing. I hope these videos are as helpful to you guys as they would have been to me. Please like and subscribe to the video if it has been. I hope to see you guys at the next one, and please leave any comments if there's some videos you would like me to discuss or go over for this upcoming 2022 real estate cycle.